lot of people talking about the rewards of cryptocurrency. Not many talk about the risks. That's not the way we're going to approach this. The biggest risk to the cryptocurrency ecosystem right now, so-called stablecoins, are like Tether. These are the ones that are supposed to be pegged to something in the real world, like the US dollar. You probably think they are. Because most cryptocurrencies are too volatile to be used in actual transactions, lots of people swap between Bitcoin and Tether or Ethereum and Tether when they want to do business. I think they're much more like stocks, but people want to claim their currencies. And that's how Tether's become the third largest cryptocurrency. Why is this such a significant risk? Because while Tether's ostensibly pegged to the dollar, it's not like it's sitting on a big pile of greenbacks. Instead, each of these stablecoins is backed by Tether's reserves, and unfortunately, we don't really know what those reserves are, except that they include a ton of commercial paper, short-term loans to unspecified companies in unspecified regions. That's why I raised a bunch of questions about this thing, because we need those answers. I think they have adopted an ill-advised strategy with little transparency. Since then, we've had a lot of developments in the space, but not many answers. Instead, in the last months, lots of important institutions and politicians have started looking into the risks from stablecoins, especially Tether, perhaps at our incessant prompting. I think that's fine, but it's also a step in the right direction. But not enough is being done to fix what many, including some of my Chinese sources, say is a ticking time bomb. So let me catch you up on what's been going on here since we first brought it to your attention. As I told you last month, Tether has more than $60 billion in reserve assets. And as of their last disclosure, roughly half of that is commercial paper, which would make Tether one of the largest holders of commercial paper on Earth. But here's the problem. I know a lot of people in this market, and nobody in the commercial paper world that I know seems to have ever heard of these guys. And that's what Tim Massid, he was the former chairman of the Commodity Futures Trading Commission, an old buddy of mine from law school, told us last month. Then a few hours later, the Financial Times published a piece where they uncovered something similar. Listen to this. Quote, until last week, we hadn't really heard of them, end quote, said a trader at a large bank. It was news to us. In other words, if they're not trading, if they were trading our commercial paper, everybody would know them because they're so big. Remember, these are short-term loans to businesses, but we don't know which businesses. So if major players in the industry haven't even heard of Tether, and that means major traders, you got to wonder whose paper they're buying. And when we reached out to Tether for more clarity, they told us that they hold commercial paper from, quote, international issuers, end quote, which I don't think is that much to go on. They also made it clear that none of this paper comes from cryptocurrency exchanges, whoa, which is good, but not that illuminating. Whose paper is it? Tether says they're buying this paper through bank intermediaries. So maybe that's why nobody's heard of them, but we don't know who those banks are. More important, we don't know what part of the world this paper is coming from. Because now, here's why this is important. See, if they're holding commercial paper from Chinese companies, that's a very different story than commercial paper from, say, Canadian companies. Call me a skeptic about Chinese bank commercial paper. What else? 3 weeks ago, another one of these stablecoins collapsed. This is Titan, a decentralized finance token that supported an algorithmic stablecoin called Iron. Now, it's a different beast than something like Tether, but what matters is Titan went to zero in a matter of minutes. That made a bunch of headlines, in part because some big-name investors like the very smart, good guy Mark Cuban got burned. Now, Cuban's calling for more regulatory oversight here, and he's a pretty influential guy. I hope we get it. Here's what really caught my eye and why we had to go back. 2 weeks ago, Eric Rosengren, when I was on vacation, the president of the Boston Fed gave a speech where he highlighted stablecoins like Tether as a major potential challenge to financial stability. He's not super worried about crypto ecosystem, but if something like Tether falls apart, that could have a major impact on the short-term credit markets, too. Last week, Fitch, totally reliable outfit, split right down the middle, one of the big three ratings agencies, spelled out these risks in more detail. Basically, if there's a run on Tether, they have to sell their reserves in order to pay off people who want to trade in their coins for dollars. And that would mean selling a ton of commercial paper, given the amount they own. That would certainly have an impact, especially if President Xi ordered it. Fitch also points out another potential problem, something that, like Tether, quote, may not be stable if short-term credit spreads widen significantly, as has occurred in times of financial stress in 2020, 2007, 2008. This contrasts with the way stablecoins are marketed to the public, end quote. suboptimal. Finally, 2 weeks ago, Senator Elizabeth Warren, whom we're trying to get hold on to come on the show to talk about this, published an open letter to SEC Chairman Gary Gensler, who has a lot on his plate, calling for greater oversight of the crypto ecosystem. She's not specifically focused on stablecoins, but she points out that crypto markets are ripe for manipulation and outright fraud, and she wants to make sure someone at the SEC is on the case. Once the federal government starts shining more of light on crypto, I have to believe stablecoins like Tether will emerge as a major point of focus. I think this is a much better use, by the way, of Senator Warren's time than coming after Jamie Dimon from JP Morgan for charging people overdraft fees, which we don't like. Now, something else has changed in the last month, beyond the fact that Tether's getting more attention. In the first 5 months of the year, the amount of Tether in circulation surged from 21 billion to more than 62 billion, practically in a straight line. In the last month, though, it's pretty much flatlined, actually down very slightly. That may be because crypto hasn't exactly had a great month, with Bitcoin down a few $1,000 versus June 9th. When we reached out to Tether, they said that demand is down. But this is a chicken and egg problem. Does demand for Tether rise as Bitcoin goes up, attracting more investors, or does the creation of Tether drive the price of Bitcoin higher? Remember, lots of crypto trades use Tether to buy Bitcoin with borrowed money. Obviously, correlation does not equal causation, but it sure is interesting, isn't it, that Bitcoin can't seem to maintain a sustainable rally once Tether stops being created. One more theory. This one's a little out there. Many people worry that Tether's commercial papers from Chinese issuers. This is a Hong Kong-based company, after all. We know there's been a rolling crackdown on cryptocurrencies in the People's Republic of China. They're trying to stamp out crypto completely. So it's possible that many of the institutions Tether was buying its commercial paper from could be now barred from doing business with it. Well, that's pure speculation, though, but a lot of people have been turning it up to me. Again, I'm not trying to bash crypto, the opposite. I think we need some kind of stablecoin to facilitate digital transactions, but Tether's way too opaque for me. We need the same transparency we get from traditional money funds. What would good stablecoin look like? Maybe USD coin, which has grown into the 8th largest cryptocurrency and the 2nd largest stablecoin because it offers more transparency. USD coin is far from perfect, but it's a U.S. company operating under U.S. financial technology regulations with a U.S. order and U.S. bank accounts. It's got some flaws. Last year, it went from simply holding cash to holding cash plus approved investments. And just like Tether, we don't have much insight into what those investments are. Oh, and the company behind the One Circle plans to come public by merging with a SPAC, so be prepared to hear more about it going forward. The bottom line, it's been a month since we started covering the stablecoins, and Tether still remains a decidedly black box. But at least the powerful people are starting to take notice of what's going on here. This stuff is too important to the crypto ecosystem not to be regulated. We think it's our duty on this show to point out the weaker links in crypto so you and the regulators know the risks facing crypto and crypto owners, including yours truly. Dan in Texas. Dan.
Hey, Jim. Thanks for taking my call.
Of course. Thank you.
I'm an Action Alert member and own many of your names. Thank you for that.
Thank you.
But I wanted to play crypto, and I was trying to find a way to get into crypto without actually owning the actual coinage, but to own a business that benefits from it. So back in mid-April through mid-May, I was buying Coinbase when it first came public, and it hasn't done so well since then. I'm wondering, what should we do? Should we hang on? Should we sell? Should we buy more?
No, I actually think it's stabilizing here. You know, I had more faith in Coinbase. I'd like to have them come back on. I'd like the CEO come back on because I think it might be making a base here, and it is an important. I was surprised. Look, it was launched in a strange way, and I was trying to get people to not overpay by giving a price that I said, please don't overpay, and then it went right beyond it, and then it went down. My take on this is that it's finally reached a level. There was a lot of insider selling, and that really hurt people, but I think we're okay here. Let's go to Raymond in California, please. Raymond.
Hey, Jim. I've been following you for over 15 years.
Oh, wow.
It's first time calling in.
Okay.
Thank you and your team for all the hard work you guys do. I had a question about
Thank you. I mean, I should have thanked that our previous time about Action Alerts. I mean, people are so delightful. It's Friday. I got to kick back and thank people for calling in and following for 15 years. How can I help you?
Hey, had a question about Marathon Digital Holdings, ticker symbol MARA.
Okay.
With the expected volatility in Bitcoin and the entire crypto market, What's your take on the biggest and best Bitcoin miner in North America?
Well, they are, exactly. That's what I would say. They're business best, and sometimes I like to own the picks and shovels. And you've got a good one. I have looked at this Marathon Digital, and time and again I've said maybe that's the one rather than Coinbase. I should be saying is a way to be able to play this rather than just going and buying the actual crypto, because a lot of people don't want to do that. I got comfortable with it, but you're right. This is a good one. All right, Tether remains cryptic at this point, and it has to be regulated. It's just too important to the crypto ecosystem, and I know the New York State doesn't even let it happen here. Now, much more Mad Money ahead, including my exclusive with Lightspeed, how the company is helping retail and hospitality players go digital, particularly at the register. Then I'm talking with the CEO of Lightspeed. I'm sorry. Then forget recovery shaped in L, U, or V. I'll tell you why and what we're seeing in the market, and it has nothing to do with the alphabet, but you're going to remember it. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.